In September 2022, the United Kingdom was hours away from total financial collapse. It wasn't a banking failure. It wasn't a stock market crash. It was a quiet, invisible meltdown in a market most people don't even know exists: the sovereign bond market. In a matter of days, the bedrock of the British economy fractured. Over $1.5 trillion in pension funds were suddenly on the brink of being wiped out. The media blamed the Prime Minister. They blamed the new mini-budget. But the politicians were just the distraction. This is the story of how a massive algorithmic margin call fired a world leader, and how the bond market proved exactly who really controls the country. To understand how a nation almost goes bankrupt in a single afternoon, you have to look at the most boring industry on earth: pensions. For decades, British pension funds made a very simple promise: guarantee a fixed monthly income for millions of retirees until the day they die. But following the 2008 financial crisis, interest rates flatlined. Suddenly, keeping that promise became mathematically impossible. The funds were slowly bleeding out. So the quantitative engineers in the City of London invented a solution. They called it liability-driven investment, or LDI. On paper, it was pitched as a genius, risk-free hedging strategy. In reality, it was a hidden leverage machine. To chase higher returns, pension funds began borrowing billions of pounds against the safe UK government bonds they already owned. They took that borrowed cash and bought even more bonds, and then they did it again. It created a massive, invisible loop of debt, quietly tied directly to the stability of the British state. As long as the government bond market remained perfectly calm, the illusion held. But leverage is a loaded gun, and all it takes is one reckless political decision to pull the trigger. September 23rd, 2022, the British government, led by a brand new Prime Minister, announced what they called a growth plan. The media called it the mini-budget. It was a staggering, unfunded £45 billion tax cut, the largest in half a century. And it was to be paid for entirely by borrowing more money. The global financial markets didn't just react. They revolted. Investors looked at the math, realised the UK could not afford it, and immediately started dumping their British government bonds. When everyone sells at once, the price of those bonds plummets. And when the price of the bonds plummets, the interest rate, or the yield, skyrockets. This was the trigger. The pension funds, holding hundreds of billions in LDI contracts, were suddenly caught in a death spiral. Their entire strategy was built on the assumption that bond prices would remain stable. Now, the prices were in freefall. The banks that had loaned the pension funds the money suddenly panicked. They issued massive margin calls, demanding billions of pounds in cash instantly to cover the mounting losses, but the pension funds didn't have the cash. To survive, they had to do the one thing that would make the crisis worse. They had to sell their bonds into a crashing market. It became a self-fulfilling prophecy. To survive the margin calls, pension funds desperately needed cash, so they sold the only liquid asset they had, their UK government bonds. But when hundreds of funds dump billions of pounds worth of bonds into the market at the exact same second, the price collapses even further. Lower prices meant the banks demanded even more cash, which forced the pension funds to sell even more bonds, which crashed the price again. In finance, this is known as a doom loop. By Friday morning, the sovereign bond market of the fifth largest economy on Earth had essentially ceased to function. Traders were staring at their screens in absolute disbelief. There were no buyers, only sellers. Behind closed doors, the Bank of England received a terrifying assessment. If the market continued to freefall, multiple massive pension funds would become officially insolvent by that afternoon. It meant millions of British citizens were just hours away from seeing their life savings vaporized. The invisible loop was about to break the country. The Bank of England faced an impossible choice: allow the sovereign bond market to collapse and watch the pension system evaporate, or intervene and risk destroying the value of the British pound entirely. They chose to intervene. At 11 a.m. on Wednesday, September 28, the Bank of England issued an emergency, unscheduled statement. They announced they were stepping in as the buyer of last resort. To break the doom loop, the bank pledged to buy up to £65 billion worth of long-dated government bonds. When everyone else was panic selling, the central bank became the only buyer. But where does a central bank get £65 billion in cash during a crisis? They print it, or, in the modern era, they create it digitally, out of thin air, with a few keystrokes. It was an emergency dose of quantitative easing. They flooded the market with newly created money, artificially driving the price of the bonds back up and the interest rates back down. The margin calls stopped. The panic was temporarily frozen. The pension funds were saved. But the bailout came at a massive cost. The Bank of England had essentially been forced to fight the government's own economic policy. The Prime Minister's tax cuts had lit the fire, and the central bank was forced to print billions just to put it out. The UK had survived the immediate crash, but its reputation as a stable, sensible economy was in ruins. The market had been temporarily stabilised, but the political damage was absolute. Just 3 weeks after standing at the podium and announcing the mini-budget, the Chancellor was fired. Days later, the Prime Minister was forced to resign. Her tenure had lasted just 49 days. She became the shortest-serving Prime Minister in British history. But the real victims of this crisis weren't the politicians who lost their jobs. The Bank of England's emergency intervention had a devastating, permanent side effect. To fight the inflation caused by the crashing pound, the central bank was forced to violently hike interest rates to levels not seen in over a decade. This meant the cost of borrowing money skyrocketed overnight for ordinary citizens. Millions of homeowners across the UK suddenly saw their monthly mortgage payments increase by hundreds and in some cases thousands of pounds. The financial media dubbed it the moron premium. It was a permanent monthly tax levied directly on the British public, caused entirely by the recklessness of their own government. Even today, the UK housing market is still paying the price for those 49 days of economic chaos. The 2022 mini-budget crisis is a terrifying masterclass in the fragility of modern finance. It proved that the era of cheap money is over. It proved that no country, no matter how historic, wealthy, or powerful, is immune to the laws of mathematics. When a government tries to borrow its way to prosperity without a coherent plan to pay it back, the market will always find out, and the market will always win. If you want to keep unmasking the invisible forces that run our world, make sure to subscribe. This is The Blueprint. Thanks for watching.